if you consider the concept of insurance, I'm paying someone to assume the risk of loss. So I'm paying a premium because I'm going to die, and the life insurance policy is going to pay a death benefit to my beneficiaries. With universal life, the risk of a death benefit being there is retained by the policyholder. So it violates the very essence of insurance. With universal life insurance, it's actually two components to a policy. It's a permanent policy, no question, but internally you have an increasing cost of insurance, the death benefit. So as we age and we get closer to mortality, the cost of the insurance goes up. And actually there's an exponential curve within the policy when you look at the cost of the insurance. The other component is a side fund or a pool of money that earns interest. So if we look at universal interest, it first came out, in the 80s when interest rates were very high. CDs, you could earn 10, 12, 14% on CDs. So it was easy to use those, or the policies looked very well, illustrated very well when you had such a high interest rate. However, we're in the lowest interest rate environments ever. So we're in the lowest interest rate environment of our lifetime. So when you put capital or premium into a universal life policy, the cost of insurance and all of the charges come out first, and then the remainder is put to interest, whether it's a fixed interest rate or an indexed, if it's indexed to an outside indice. If those indices don't return sufficient amounts, the policy will cannibalize itself, and it typically happens when the policy owner is in their 70s or 80s. It is too late to recover. You will be the last to know, and you'll be in a situation where you can't fix it. The cost of insurance is so substantial, the rate of return can't overcome that internal cost of the death benefit. The interest rates are so low, you can't earn enough to offset or to compensate for the rising costs of the insurance, the death benefit. The same with the equity index universal life. The outside indices are going to have to return 6 to 8% a year, year over year over year for the next 20 or 30 years to be able to produce enough earnings to overcome the internal cost of the insurance. It violates the most basic principle of insurance because I'm still retaining the risk. Now, I don't have any market risk. The risk that I have is the indices don't produce enough return to have the death benefit in place.